Hi, everybody. Thanks for joining. Mike here at Eagle Home Financial. We get questions all the time just about mortgage things that aren't standard knowledge, and so I wanted to go over some of those. So the first one we're going to talk about here is points. Are a common thing in the mortgage business, but you don't think about them on a regular basis, and so I want to go over what they are, how they're used, and whether or not it makes sense to use points as a part of a transaction that you're involved with. So we'll get right into it here. So it's very simple what it is. How it's used is a whole other story. So they are 1% of the loan amount. So not the purchase price, but whatever the loan amount is, 1 point is equal to 1%. So you can pay points to buy down the interest rate. So essentially getting a lower interest rate by paying a little bit more money to buy the interest down or pay some points. So we'll go over those percentages here just to make it easy. The math is pretty simple or straightforward. So on a $90,000 loan, 1% is $900. 1 point is $900. 2 points, $1,800. On a $200,000 loan, 1 point is $2,000. A point and a half is $3,000, and so forth. So the other term that comes up sometimes, especially with us inside of the business, we talk about basis points all the time. So basis points and points are the same thing, essentially, but a basis point is, just to make it nice and confusing, is 1% of 1%. So for example, on a $200,000 loan, 50 basis points is going to be a half of a percent of the loan amount, which is $1,000. Or 180 basis points is 1.8% of that $200,000, which is $3,600. So you can spend money on buying these points or paying for points in order to get a lower interest rate on your mortgage. It does a couple of things. It brings down your monthly payment. It also can accelerate the equity that you gain in your house. When you pay less for interest, more of the monthly payment, more of your monthly mortgage payment actually gets applied to principal versus the interest. So you can bring down your loan amount faster, and then also qualifying for a home if you're right on the bubble for the debt to income ratio, which means all of your debts plus the new mortgage payment held up against what your income is. If you're really tight, say you're trying to buy a $400,000 house and you qualify for $395,000, but you really, really want to get into this house, you can pay, instead of paying more on a down payment, we'll go over the difference between paying more on a down payment and paying points down in a little bit. What you could essentially do is pay some points, bring down your interest rate, which brings down that monthly payment a little bit, and potentially qualify for that higher loan amount. So here are some considerations to have in mind when thinking about paying points. One of the biggest factors is how long do you plan to stay in the loan? So there's a cost to refinance. And there's also, when you're purchasing a house, just the cost of paying those points in general, you want to make sure you're recouping those costs. Otherwise, it doesn't make sense to pay the points. And so, for example, if you're going to spend $3,000 buying points down and you're bringing your monthly payment down by $100 a month, well, that means it's going to be 30 months, actually a little bit less than that because more is going towards principal, but just to make the math easy, about 30 payments to recoup the $30,000 that you spent on points. So if you're only planning on being in the house for 2 years or refinancing within that 2.5 year period, then it doesn't always make sense to pay those points. So you got to look at where that break even point is and then decide if it's going to make sense or not. Actually, that last bullet point there is just making sure that you're conscious of those additional costs to close, because you're combining your down payment, your closing costs, taxes, insurance, along with paying the points. So just making sure that it makes sense for you budget wise to pay for those points. So there's a lot here to go over on this screen, so I'm just going to break it down one thing at a time, because this is kind of where things get really confusing. From the mortgage side of things, we look at this type of stuff all of the time, but from the general public, or somebody buying a house or a real estate agent, you're not going to see these grids, and so it's really important to have a loan officer that you can rely on and that you trust to be looking at these grids the right way, especially when you work with independent mortgage brokers like us here at Eagle Home Financial. We work with a bunch of different lending companies who offer all different loan products, and they also have their own rate sheets. This right here is a rate sheet from one lender in particular, and it shows this screenshot of their pricing grid because it gives a really good example of what I'm about to talk about here. There's these things called batches. You can think of it as it's like a bucket of loans that an investor has decided, okay, we want this type of loan with this interest rate, and when that lending company fills that bucket, when they get all of these loans that meet this criteria, they're going to sell those loans off to that investor on what's called the secondary market. And so that's why sometimes you're going to have an interest rate. So right here, if you look at the green highlighted rate, it's paying 0 points. So right here is the rate. Whoops. Don't worry about the base price. Just focus on what the rate is, what the points are, and what the monthly payment is. So if you look at 6.855 paying 0 points, here's your going monthly mortgage payment. This is just principal and interest, so $24.58. Now, however, there's going to be a cost of $1,500, so you're paying 0.402 of points to get that 6.75. But if you keep going down the line here, a 6.625, you're paying 0.022, so $82 to get down to a 6.25 versus 6.75, it costing $1,500. So you really want to make sure the loan officer is looking at this pricing grid and making sure that, hey, don't just give that 6.8. Go look down right here. There's 6.65, and if you're willing to pay a point to buy the interest rate down, well, look, here we go. We've got a 6.375 paying less than a point. That's $3,000. Looks like this was probably based on a $400,000 loan amount and a payment of $23.39, but looks like we've got another batch over here. So 6.125, you're still under a point or almost right at a point, paying $3,700, and you can bring your payment down even more versus that interest rate that's right in between them, that 6.25, paying over a point, 1.368. So you'd pay $5,000 to get that. You might as well pay $3,700 and get the 6.125. And so that's the main point I wanted to make. You don't have to understand everything that goes on in the secondary market and behind the scenes and everything. You just have to know that paying points, sometimes the pricing grid from a lender, it's not always 1 point equals this, 2 point is this rate, 3 points is this interest rate. It kind of depends on what investors, what they have going on in the secondary market at the lending company. So a lower rate equals faster equity. I mentioned that a little bit earlier. I just wanted to go over this really quickly to point out the fact that when you buy the interest rate down, a lower interest rate means that less of a percentage of your monthly mortgage payment is interest. And so you're applying more towards the principal every month. So you're going to reduce your loan balance faster. I'll go over exactly what, an example so that you can see. There's a lot on the screen, so I'm going to just kind of break down what we're looking at here. So we've got on the top left here, we've got a loan amount of $250,000 with an interest rate of 7%. It's a 30-year fixed rate loan. That's 12 payments a month. Okay, so at this $250,000 loan amount, the monthly payment is going to be $16.63 a month. Okay, now if we look over here, you're going to pay some points down. We're at a 6.5. I did these screenshots a couple of weeks ago, so rates are a little better now than they were here. So don't judge by the actual rates. This is just for an example. So 6.5% interest rate. Obviously, the monthly payment's going to be a little bit lower. It's $1,580. Okay, so after 18 months, we're not going to have a huge difference, but after a year and a half, you're looking at a principal balance of 246,348 on the 7% interest rate, and a principal balance over here of 245,986. So not a huge difference. That's a $360 difference. But you've also spent $1,495 less after making this lower monthly payment for 18 months. So the difference between these two times 18 months, and you're saving almost $1,500 there, and you owe $360 less on your mortgage at that point. So down the road, as you stay in the loan for longer and longer, it's going to make even a bigger difference. So same pricing scenario here and over here, and now we've scrolled down this amortization schedule. If we just take a snippet here of it, let's say the 60-month line. Now we've got a loan amount on this side of $235,000 and a loan amount over here of $234,000. So it's actually a difference of $1,279. And in the meantime, you've also spent less on your monthly payments. So after 60 months, you've spent almost $5,000 less in the monthly payment, and then you have a lower principal balance of $1,279 on the loan. Break even points, some things to pay attention to. So not all rates are created equal. Not all buy downs are created equal either. That's why it's important, like I was saying, to make sure you're talking to your loan officer to make sure that you're paying the right amount of points and that it's making sense for you. Some of the factors to pay attention to is one, how long do you plan on staying in the house? Because if it's only a couple years, then maybe it doesn't make sense to buy the rate down. If you plan on staying in there for 30 years or forever, then and depending on where the rates are at the time, then it might make sense. However, the next bullet point there, the how long do you plan to live in the house, and then what is the projected market for the foreseeable future? So if rates are going to go down or predicted to go down, there's a good chance you might refinance. And if you're going to refinance before you recoup your costs, then it doesn't make sense to do the buy the rates down or pay points. You could also use some seller concessions to buy the rate down as well. And what funds do you have available to buy the rate down? So if you're gonna, obviously you can't spend more than you have or more than you have budgeted for down payment, closing costs, and then paying points. So just some factors to take into consideration there. So just like getting a lower interest rate by paying points, you can also get a lender credit by taking a higher interest rate. So it goes both ways on the scale here. So if you look at, this is the same pricing grid. I just added in the higher interest rates here so that you can see the example. So an even par interest rate at 6.855, paying 0 points. Say you needed a little help for closing costs. You could actually take a 7.5% interest rate and get $4,600 applied towards your closing costs. Or if you really got to go for it, take that 8.125 and get $7,500 applied towards your closing costs. Of course, you're going to have a higher monthly payment. You're going to spend a lot more in interest on your mortgage. But if it's the difference between getting into the house or not getting into the house, this is just fuel. This is just information to help make an educated decision. And then potentially, if you're in this type of scenario, of course, we look at trying to get a refinance down the road as soon as possible to get into a lower interest rate. But for now, this could make the difference to cover some of the closing costs. Using seller concessions to pay for points. So here's an example that I put together. If we have $8,000 in seller concessions and $6,800 in closing costs, you've got a leftover dollar amount of unused seller concessions. So, for some reason, $8,000 was negotiated during the purchasing negotiations, and $8,000, there's not even $8,000 in closing costs. If you don't use those, it goes back to the seller. So you might as well apply it somewhere and take a better interest rate. So here, we've got a leftover $1,185 in unused seller concessions. So why don't we go ahead and buy the interest rate down an eighth, pay those, use those seller concessions right here. So rather than that even par rate of that 6.855 that we had earlier, we pay we get an interest rate of 6.52, paying that additional seller concessions. That way they don't go to waste, and you get a lower monthly payment. It's a win-win situation. So should I pay points? This is a question that we get all the time too, that can be a little bit confusing because people, we just have this thing in our mind that we think that, okay, in order to get a lower monthly payment, I need to put more money down on the principal balance. Well, that can be true because you can't just buy an interest rate down to nothing. The lending companies cap it at a certain point. So you're really talking about the smaller dollar amounts. If you're looking at, in this example, paying $5,000, putting an additional $5,000 towards principal or $5,000 as additional down payment versus putting $5,000 towards buying the interest rate down, there's a huge difference in the amount of money that you're going to save in the long run. So this is a $300,000 purchase, putting 10% down, paying with no points. The monthly payment is $21.16. Okay, you can see here the interest rate at 6.913, no points, small mortgage insurance, and then the monthly payment. So the first example here is applying $5,000 towards buying the interest rate down or paying points. Now the monthly payment goes down to $19.27. That's a savings of $189 per month versus if you were to put that $5,000 as a down payment, your monthly payment would be $2,083. So that's only $33 less a month by increasing your down payment by $5,000. So obviously it makes a lot more sense in that scenario to pay some points versus put it into paying principal down. So how much would I have to put down to match the rate buy down? So in order to get the benefit of the 5,000 in points, you'd have to put an additional $26,000 down to get that interest rate. So yeah, you either pay $5,000 to buy the rate down and get a $19.29 a month payment, or put another $26,000 in down payment to get that same interest rate. One last thing I wanted to touch on real quick, because I see it all of the time, is these predatory lenders out there who will advertise these amazing interest rates. And now you know what's going on here behind the scenes is these lenders will either not tell you about points, or they will put them in the fine print so that you're not really aware, and you're kind of trusting this loan officer or this lending company to give you a really nice low interest rate, and then they just never even talk to you about the points that you're buying or paying down. And so, yeah, you get this great low interest rate. Your closing costs are also that much more expensive in order to buy those rates down, and they're just not bringing that up. So always pay attention to, if there's these lending companies out there, especially if it's a billboard on the side of the highway and every day it says the same interest rate. Listen, interest rate changes like a stock. I see it throughout the day. We get updates on what the interest rate is. It can be different at any given time. So if you're looking at a billboard on the side of a highway that says a fixed interest rate, there's something going on there. You're paying points, or something fishy is going on. So just pay attention to that type of thing. Always check the fine print, and work with a mortgage professional that you either know, or somebody that you trust, somebody that was referred to you by a friend or a family member who you know is going to help lead you in the right direction there. So in conclusion, obviously how much you spend on points matters. It's important to have an understanding of buying down or paying points when you're either refinancing or purchasing a home. And so it's good to make sure you're really talking to the mortgage broker that you're working with in order to maximize your financial benefit over time. I am more than happy to answer any questions. If I left something out, please let me know, and I'm here to help. So thanks, guys.